Superannuation funds are likely to enjoy the highest returns in 4 years as global share markets rise. Markets around the world enjoyed spectacular gains in 2017. Hong Kong, the US and China's Shenzhen up more than 20%. Japan and Germany not far behind, and Australia rose a respectable 7%. But why did we underperform? Commodity prices recovered in 2017, making for a good year for Australian miners.
IT and healthcare were also quite robust, and those sectors that had strong links towards China also performed exceptionally well in 2017.
The emergence of the Chinese consumer drove many local stocks, particularly in the food, wine and infant product markets, along with battery component makers for electric cars.
China is rapidly developing its e-commerce business, and the consumer there is rapidly changing their consumption patterns. So that economy is probably doing in 5 years what Australia's taken 50 years to do in terms of change.
But it wasn't enough to propel our share market to the heights of its global competitors, which have a larger focus on technology and online companies.
Our market is very heavily into banks, telcos, retailers, and those sectors have really struggled.
Retailers are facing online challenges, and issues with the NBN have impeded the telcos. The banks are dealing with regulatory changes and the upcoming Royal Commission.
Their dividends will be safe and sound, in our opinion, for the coming 12 months.
Still, superannuation accounts are likely to have received a welcome boost.
We expect the median growth fund to return about 10.5% for the year.
That's the best result for growth funds since 2013, when investors saw a massive 17.2% return.
The surprisingly strong result for the year is really driven by strong share markets, particularly overseas markets.
Many global markets are yet to take a breather.
I think it's important to remember that the US hasn't had a real correction for the last 12 months.
And there are signs we may be at the top of the current cycle.
We're seeing in things like Bitcoin, which is the biggest mania in history. It's up almost 125,000% since the last 5 years. We're seeing other warning signs like the prices that people are paying for artwork. So we saw a record struck earlier this year for a Da Vinci painting, 450 million, which is a bit. We've seen the family moguls selling out after years, generations in industries.
Still, once the dust settles, experts say local investors should hold an international focus in 2018.
We still think the global economy will grow more rapidly than our domestic one. Look for small businesses that are quite disruptive in the industries that they perform in.
And the top stocks on the S&P ASX 200 this year include A2 Milk, up about 269% amid Chinese demand. The worst are some retail stocks like Gloria Jeans and Donut King owner Retail Food Group, along with Myer.